I'm excited on hosting or moderating today's session. We'll be focusing on empowering founders to build billion-dollar companies. For those of who don't know me, my name is Mohamed Binali. I'm a part of the Hub 71 mission, where I focus on the value creation, mainly on the capital ecosystem, where I sit between a lot of our portfolio companies and our capital partners. For today's VC Spotlight session, we have amazing guest panelists that joined us to really share their insights. We have Omer Zabit, who's a principal at Shorooq. Shorooq is one of, if not one of the first VCs to set up in Hub 71 and ADGM, and now has grown to have multiple funds and maybe one of the big regional funds that are fueling the ecosystem. Our second panelist is a guest from the UK, Mr. Neil Woodford. He's an economist from Woodford Views. Neil has invested more than £3 billion to support more than 100 startups, and I believe some of them have reached the unicorn status already. So thank you both for making the time to join us at Hub 71. I want to keep this an open discussion, so I'll go back and forth between Omer and Neil, and I'll leave some time towards the end for some Q&A from our panelists. Before we start with the topic, maybe we can spend a few moments. You can tell the audience who you are and what you guys do at Shorooq and Woodford View.
Thank you so much, Mohamed. Hi, everyone. Omer Zabit, I'm an operator turned investor. Been with Shorooq for about 3 years. Shorooq is one of the leading tech investors in this part of the world. Started off roughly 8 years ago, where these days actively managing 6 different funds on venture, credit, and also crypto. We have 80 plus portfolio companies, very much focused on Middle East, North Africa. UAE and Saudi Arabia are the heart of the focus for us. Sector agnostic, but we do have a preference for B2B businesses over consumer-facing businesses. Very much excited to be here and engage in this conversation. Hope you see a lot of value here.
Thank you, Omer. Neil?
Hi. Hello, everybody. My name is Neil Woodford. I've been an investor and fund manager for about 35 years. I'm based in the UK and have previously run institutional funds that invested in developed economy markets, but also in early stage businesses, science and technology, mainly focused in the UK, but then in Europe as well and in the US. I made my first biotech investment in the late 90s, and for a period of time was one of the biggest early stage investors in the UK, backing many different startup businesses, typically that had emerged from incubators, so slightly later stage than the businesses that are in this incubator. That was typically where I started to invest. And I think, last count, I think about 20 of the early stage businesses I invested in became unicorns.
So I have a lot of questions about that, how they became unicorns. But let me start off with Omer from Shorooq. Shorooq today, as you mentioned, has grown to have multiple funds. What do you guys prioritize as you look at investing at early stage investors, early stage startups that hopefully will become unicorn startups?
So on the venture side, again, pre-seed, our intention, given our fund size, is to find unicorn contenders. So we are usually not interested in companies which could turn out to be a $100 million exit. So as a consequence of that, we continue to sort of keep ourselves checked on the kind of investments we make. I'll break down what we look for in 3 different ways. First and foremost, the market opportunity. You can't really create a $1 billion outcome unless the market that you're addressing is sizable enough. Millions of people are engaging with it. There's a lot of value that you can unlock from it. Number 2 is specifically founders. There are founders who have subject matter expertise, who may coming in from outside of that sector and wanted to disrupt it. But a few unique traits we've seen on founders is an uncanny ability to inspire others on the mission that they are on. I do believe that a founder's core responsibility is to inspire their employees, partners, investors, clients. So they need to have the energy levels to do that. And number 2, I do believe the truly exceptional founders are amazing risk managers. So they, at the same time, live the duality of everything is going to go well, to everything is going to burn and crash, and they live that duality day in, day out. So that is something that we continue to sort of test out for and build a perspective on. The last bit which is important is your unique approach to that particular market. Of course, all startups you invest in are tech focused, but just applying a new tech stack to the same problem may not be enough. What is your unique insight, approach, access to in that region or in that segment is also something we are keen to understand and underwrite.
Thank you, Omer. Maybe from Neil, your perspective, right? You've already invested into several or hundreds of startups, and several of them have, become the unicorn status. So maybe can you differentiate what are the characteristics of the ones that became unicorn and the ones that didn't?
It's a really, really hard question to answer because it's not obvious at the start, and if it was, of course, we wouldn't. The riskiness of early stage investment wouldn't be there. It would be a sort of sure thing. It'd be like buying government bonds. So you don't know when you first invest which ones will become the unicorns. But I think there are characteristics that I think are common to the businesses that eventually become very successful. And I think the common characteristics are that they must have, as we've already heard, differentiated technology, something that is scalable, that addresses an unmet need or is disruptive in a particular market that isn't just regional, would necessarily be global. I think that's important. I think the people behind the business, of course, is very important. Are they inspirational? Are they prepared to put the hours in? Are they really the sort of entrepreneurs that inspire others to follow? So leadership is really, really important. And I think the other things that sort of help you on that journey, which are not obvious at the start, but are key characteristics of success, are the ability to access capital at the right stage, in the right scale, at the right time. That's really important. And the final ingredient, which I think is a massively important part of the success of this region, and frankly is not something I've seen very obvious at all in back home in the UK, which is that the government support is also essential. If the government can be your first customer, that is a very, very important determinant of future success.
I agree. I think that's why we exist as Hub 71, right? It's to build out the right partners for these startups, right? To really enable these startups not just to set up, but to actually scale, to get the right market, to get the right talent, and hopefully get the right capital to really capitalize on it. Moving into more of the challenges, right? So building a $1 billion company is extremely hard. That's why there's only a few of them, right? What are the challenges you see that these founders face as they scale and still to maintain the growth that they need to grow, right? What are the main challenges you see that they go through?
So if I may take a crack. I'll start with a bit not obvious one, but building a company is very lonely. And I think not having the right support structure around you also does not give you the right firepower to continue to keep at it. Because resilience is one thing, but you do need support for that. Early stage startups, again, don't have resources to begin with, so they need to be agile enough, lean enough. They need to have the tenacity to figure out how to navigate market circumstances, find the right customer, win them over, have the right product, continue to iterate towards it, find some PMF. So that type of resourcefulness is extremely important to get. Again, you don't have enough resources to begin with, and eventually you start locking in other things. These two broadly come to mind. I'm sure there are other countless challenges which Neil can sort of point to.
Neil, from your perspective, I think from a UK or Europe as well?
Yeah, there are many challenges. It's not easy, as you all already know. I suppose for me, let's assume that the biggest, perhaps the bit earliest and biggest challenge is the idea, the technology, the differentiated IP, whatever it is. If you've got that in place, that's crucial. But the challenges then are broadly after you've been selected for an incubator like this. The biggest challenge I think is access to capital, and having the right capital partners on your journey is vital. And I think it's the biggest single differentiator between, for example, the success we see in the US, where 8% of university spin-outs, interestingly, about 8% of university spin-outs become unicorns, and in the UK, it's only about 2%. And I think the big difference is not that the quality of the technology in the UK is inferior to the US. I think the biggest single difference, it's not about people either. I think it's all about capital, access to capital, deep pools of capital that can take you on the journey. Once you guys leave this incubator and you go out to look for capital to scale your business, the biggest key differentiator in the UK, for example, from the US is that there are deep, dedicated pools of capital in the US designed to back businesses just at that stage and to take them on that journey. I'm not saying it's easy to access, but there are dedicated pools of capital there whose objective is to invest in exactly those sorts of businesses, and they just don't exist in the UK, and it's the biggest single differentiator between success and failure, I think. So.
Yeah, thanks. I think I'll wear the Hub 71 hat here. We see two things, right? We see more than 2,000 plus applications per year. We only select 50, and the idea is we want to select the hopefully unicorns that come in, and we promote them, or hopefully give them the right exposure for them to become unicorns. But for us, what we see, what limits their scalability is really talent, right? Tech talent is limited globally. As these startups are ready to scale, they really compete with these tech talent. What we try to do in Hub 71 in Abu Dhabi is really ease up that process for them, right? So we work with regional and global universities, work with service providers, and really ease up that process to really bring in the right people. And luckily enough, the UAE has an amazing visa regime, and most recently with the golden visa, it's a 10-year visa. So really attracting the right talent, whether you're looking for talent from Eastern Europe or India or Pakistan, it's really bringing everybody into one sector. Kind of going into the next subject, and I think I need to mention this, AI. AI has been the theme in 2024, and I believe it's going into 2025. AI and frontier tech. Maybe from Shorooq and Omer, right? How do you position yourself as Shorooq when you're looking at AI or frontier tech? How do you capitalize on that?
So I'll cover both AI and frontier tech because we do sort of invest in deep tech. We have a semiconductor company, we have a biotech company in the portfolio as well. When you look at AI, we look at it as the great equalizer. Even Web3 to some extent, we have a lot of exposure there. It is sort of like a great equalizer because the right talent has the opportunity to really disrupt existing industries, and even industries which were not catered to historically, even because of the old tech stacks, right? And we have made a few investments specifically in AI which address those locked out industries as well, right? Energy is a big space, and when I say energy and sort of well maintenance, how do you go around doing that and have the right level of AI stack which is purpose built for you, like ground up, is an important one to look into. We, given the nature of who we are, we like platform plays a lot more than applications. So naturally, we're inclined towards companies in the space which have a similar type of a demeanor or a profile. One that we're looking at these days, we haven't made an investment, we're very keen about it, is in the space of data management and cleaning, because AI is just one thing, it's a bunch of algorithms that run. All the dirty work is done on data cleaning, data pipelines, management as well. So there's a company that we're actually sprinting on these days, which is building that entire infrastructure and will open it up for various other AI companies to build on top of, right? So that is interesting for us. On deep tech, one of the things, and even a lot more true for AI as well, one way that the region is behind is just sheer talent. I don't think we have the right breadth or depth of deep tech talent in this part of the world. It is changing and evolving quite quickly. We do have good universities, good research areas. And then, as you've rightly pointed out, we've been able to attract A+ talent globally for the last so many decades across various industries. Like we've just focused or started to focus on tech in the last half a decade as a region, right? So if history were to repeat itself, I do believe that in the coming decade or two, this region will create and propel like deep tech companies which are building from here, but for the rest of the world. But that, at least interim, is a challenge that we do run across. We don't have the right depth of talent on either of these frontier sort of segments.
And just a follow-up question onto that. So what would you recommend for founders who is in the AI space or frontier tech that is currently raising from investors or about to raise? What advice would you give them?
Firstly, there are very few investors, unfortunately. Like hardly anyone invests in deep tech, and not because of lack of intent. It's just very difficult to invest. Like if we are taking bets on conventional businesses, this is a complete bet, and we may not even on the VC side, we may not even have the right talent to evaluate the good from the great, to be honest, right? So one advice is that as complicated as your underlying product may be, if you can clearly articulate the commercial impact, which almost every VCs understand, they may not understand what you're building in detail, but they understand how it will show up for your partners and clients, and what will be the revenue model and the business model. If you're able to drive that forward, that would be great. But it is quite difficult. I have not yet seen people invest in pre-revenue deep tech companies. That is mostly left for universities or other academic institutes or grant-based programs. So VCs don't really engage at that level. Like the technology has to be mature enough and should be near commercialization or early stage of commercialization for VCs to be interested in that.
And I'll come to you, Neil, shortly. I think for what we see as Hub 71 at least, it's more on how do founders really plug themselves to the right investors. Capital is capital, but strategic capital is even better, right? Especially for frontier tech and AI. It's really having the right partner to provide you with the right infrastructure, with the right network to really support. Because as you mentioned, it's deep tech, right? Spend a lot of money and time at the earlier stage to hopefully commercialize. So always look for the right investors, the strategic investors within that space. Neil, I'll ask you, right? How do you see AI in frontier tech? I know you've been investing a while back, and this has kind of evolved. Yeah. What do you see it?
Look, I'm not an expert in this particular field, but my instincts are that this is a new global industrial revolution. I think it will be a mistake to underestimate the importance of AI going forward. My challenge, I suppose, is where I would look to invest as an early stage investor here, because of course we know where AI, who has the AI lead. I suppose it's the US and China. Clearly, they have the resources. They are the capex that's now going on in the US. The Mag 7 in particular are devoting hundreds of billions, if not $1 trillion, at AI investment. That's a huge problem for this region, for example, that is trying to develop competitive technology. Is it a scale game? I don't know what the answer is, but it's important that if you are developing AI technology in this region, it's got to be differentiated. If you're a Me Too, you're going to be swamped by what's going on in the US. In China, there's a different emphasis. I think there's a very clear focus on commercializing AI technology, and of course, from my perspective, I see them leading, particularly in the application of AI in robotics, and in the EV sector, where Chinese technology is substantially ahead of Europe or the US, from what I can see. So again, an early application of technology, Chinese AI technology, is driven by the need to commercialize it quickly. So it's important, I would say, for deep tech AI businesses in this region to understand the global competitive landscape. I know that's a bit of a sort of basic advice, but I would need, if I were an investor in this region looking at AI and deep tech businesses, I'd be very clear in trying to focus on differentiated approaches in markets that were not going to get overrun by the scaled US and Chinese players.
If I may, like just a unique opportunity that does exist here and perhaps in other regions as well, in sectors which are heavily regulated, like data residency is a big topic for people, like, or for like states here. I think there's room to create a company and compete with the global best as well, right? So I don't see AI coming into fintech anytime soon, or a very heavy regulated industry, right? You may be doing a credit scoring right behind a bank, but you will not come meaningfully in the foray of that anytime soon. And that is where your unique insight, presence, access matters, and that is where your partners matter as well, right? So I think that opportunity still exists, whether it be like MENA or LATAM or like anywhere beyond China and US.
So you're saying AI might be a bit more difficult for heavy regulated sectors?
Yes, and that is where the opportunity could be for local champions or local companies. I may not be able to compete with ChatGPT or Llama or someone else, right? But I can definitely compete with Palantir if I were to go deep into like defense here.
No, spot on. I think that's what the UAE and Abu Dhabi has done, right? So develop local LLMs, local infrastructure for the AI field to really for startups and builders to build on. So definitely onto that. Kind of going into the last part of today's session, right, is really on the advice part, right? Overall advice. What are the top advices you would give early stage founders? And I think this is a good perspective to get more of a MENA angle and more of a Western European and US angle. So, Omer, all right, we'll start with Neil, since you can tell us what are the real kind of top piece advices you could give.
Right. Not an exhaustive list, but this is born of my experience of early stage businesses. So what I would say to early stage founders is be prepared or be ready to relinquish control of your business. If you want to control everything, you'll get nothing done. You've got to attract great partners to come on board with you, to take responsibility. You've got to be able to delegate, okay, and delegate with confidence until you're really frightened, and then delegate again. That's important. I think if you try and control everything, it'll be a huge impediment to the growth of your business. Second thing is to try and cultivate long-term relationships with capital partners who can be with you on your journey. It's easily said, very hard to do, but the best capital partners are the ones that can be with you, those sort of evergreen partners who can be with you on the journey from the incubator through to commercialization when you're generating cash and you don't need the capital support anymore. I think that's really, really important. And the other thing, I suppose, is that, and it comes back to the first point in relinquishing, being prepared to relinquish control. I think you also need to prepare yourself as a founder to spend most of the time, once you emerge from somewhere like this, you will spend most of your time raising capital, talking to investors, holding their hands, going through endless meetings, repeating the same sort of message, and getting very frustrated from time to time with people who take forever to make an investment decision. But be prepared to use most of your time doing that. So what that means, of course, is that you need to have really good people around you who can run your business whilst you're away talking to investors. So that would be 3 of my sort of tips.
So building the right team. Omer, anything from you?
So for me, startups are all about momentum. Momentum on early traction, revenue, your investor conversations, your excitement around it. So having the right type of balance between cost consciousness and burning your way through growth versus having enough of a runway, but still managing that trade-off between burn and growth. I think never ever lose momentum in talent, interaction, and sort of investor conversations as well. A lot of the founders make that mistake, and the company ends up being any other company. It's no longer a venture outcome. One of the things I learned over the last few years of doing this is that there are good companies, bad companies, there are good venture opportunities, bad venture opportunities, and then there's a good Shorooq opportunity, bad Shorooq opportunity. So please differentiate who you are. You're not really an SME, you're not really a lifestyle business. You're out there to create outlandish returns for yourself and impact as well. So for that to happen, you need to stay true to your mission and have the right momentum behind it. And don't be disheartened if you say a lot of no's, because the last part, like for instance, we don't really invest in edtech or e-commerce that much. A lot of people do, right? So if a lot of no's are coming, then find the right partner and investor for you. Because one thing I candidly tell founders during these investment processes is the last thing you want from us is to take our money and for us to not really be like invested in you emotionally. Like there are business models and sectors where the broad team is interested, and we will work alongside you on those because we are excited to invest in those sectors with you. Like don't really expect me to put in the same number of hours to understand how you will sell more products on a D2C brand. Not really my calling in life, right? So also differentiate that.
What is the hottest sectors for Shorooq today?
In the pipeline, forget the pipeline. Historically, we've started to prop tech a lot more, which is interesting. We thought about it H2 of last year, and then we executed on a few deals. In the pipeline right now, we do have a few AI companies and health tech, which is interesting for us. Again, like we've done almost anything there is to do on fintech infra. Think of a company, I'm sure we have that in our portfolio. And they're scaling and growing. And the other one which I personally really like is energy transition and like EVs. So like we've made one investment so far in that sector, which like I'm very, very excited about.
I think building a billion-dollar company takes a lot. And we were speaking about this earlier on. You need beyond the UAE, you need beyond the MENA, right? You need a big market. So you always need to build for the world. So build from Abu Dhabi to the world. And this is what we were speaking about. And Neil, I'm sure you have more experience in the UK seeing startups really scale and kind of look globally rather than just the UK and Europe, right? So really looking at a global market. And moving into the last part, I want to move into some Q&A from the audience. So if you do have questions for our great panelists, please raise your hands and we'll pass down the mic.
I had a couple of questions for Shorooq partners regarding to your regional involvement. So you have offices in Abu Dhabi, and for example, if startup is focused for initially in Saudi, we have to speak with Saudi office, or we can do it anywhere based on your location?
So from your perspective, you should not be worried about who you're speaking with. It is my responsibility to direct you to the right person. Like assume that you and I chat and you are a Saudi company, I will very quickly move it to the Saudi partners of mine, but you don't need to worry about it.
Okay, second question regarding to Sharia compliant funds. Is there any specific fund which is focused more on Sharia compliant, and how it is there?
So I think people know this, but we are a Sharia aligned investment firm. We don't invest in certain sectors because of our own adherence to principle. We don't use the word Sharia compliant, so that's slightly different, but we are very much aligned on that. Any company is fair game as long as Sharia compliance is concerned for us. Like.
Hi, my question's for Neil. So Neil, you are one of the most significant and influential early stage investors in a company I'm really interested in, Oxford Nanopore, which is one of the leading DNA sequencing companies globally. And I believe they've also got a presence here in Abu Dhabi. Of course, like most biotech and emerging tech companies, they went through a lot of twists and turns along their way to commercialization. In a nutshell, what was it that inspired your faith in them early on, and your belief in their long-term potential?
Thank you. Not a question that I can answer sort of in a couple of sentences. I suppose there were lots of things, but I first met the business 4 years after its formation, so it was still a very early stage business. In fact, I had previously not turned it down, but I'd previously looked at it and thought, I just don't really understand the technology. It's not for me. It's a little bit too challenging. Anyway, circumstances meant that I had another opportunity to look at it. And once I'd met the CEO, I think that was a sort of a light bulb moment for me. He was inspirational. He had all the key ingredients I wanted in an early stage business. He was incredibly aggressive, incredibly ambitious, incredibly energetic, and very smart, and had surrounded himself with some great people. So all of those were key ingredients. But equally, I was very aware, because this technology was so disruptive, because it was so new, because it was cutting edge in a very genuine sense, it was not going to be a quick route to commercialization. Anything in biotech, I mean, there are some fantastic investment opportunities in biotech, particularly now, I think. But you have to be prepared for a long and capital-intensive journey to commercialization. And that's I went into my early investment in Nanopore knowing that was going to be the journey. And it turned out to be so. I mean, it took from when I first invested in 2010, it was 12, 13 years before the business became commercial. So it was a long journey, but and there were many twists and turns. There were many sort of very important technology challenges that had to be overcome with a new approach. So again, I suppose this is a thing for technology businesses. Be prepared to pivot with your technology. Be prepared to confront something that will make you think, oh my God, how am I going to get around this particular problem? And you've got to be flexible enough to pivot, as that company did on numerous occasions. It was not a smooth path from sort of discovery at Oxford University through to commercialization. It was a very, very tortured road. But that business, with perseverance, got there. And it's now, I think, an incredibly important business that has the potential to become, I think, a multi-billion-dollar company. I mean, it's already now a billion-dollar company. It's a unicorn. It's listed in London, but I think it has the potential to become a genuinely huge business. So it was a long and interesting journey, a great journey. But ultimately, I think the key ingredient for me was the people, actually, the leadership.
My question is, regarding the technology you just mentioned, I'm aiming to integrate it and kind of commercialize it in the UAE region and also the Saudi region, as there's a lot of high demand for things like genetic counseling and a lot of genetic diseases. So my advice, not my advice, I'm asking for advice. How would you approach kind of the challenges of, balancing cultural and, kind of niche technologies into quite a new region for the industry?
Thank you very much. It's not an easy question to answer. And of course, I'm not from the region, so I won't understand all the cultural sensitivities of this region. But my guess is that the success for a business like Oxford Nanopore in a region like this would be to work hard at integrating with the health system, particularly because early adoption of the technology and all of the insights that it can reveal about genetic predisposition to disease, inherited disease, all these sorts of things can be, the huge amount of information can be gleaned from a genetic profile. And what I think that is, for me, the key for health systems is to move from a very expensive approach to treating disease to one that prevents disease. And that is not only much less expensive, but it's much better for patients, much better for the population. So this is a key tool, I think, in that early intervention, early diagnosis, understanding predisposition to disease. So my guess is that if I was advising Nanopore now to sort of how would you commercialize in a region like this, would be to build a great relationship with the government, help the government to understand the power of the tool, how it could, for example, be used in education at a very early stage, how it can be used in the health system, how it can be used in primary care, not just in hospitals when somebody's presenting with a disease and you're trying to work out what it is, actually know that that patient is likely to develop whatever at some stage and therefore intervene early. That's how I would approach it. I hope does that answer your question in a way?
Yeah, definitely. Thank you so much.
Thank you.
You said regarding the health tech, how Shorooq differentiate like the right ideas or the good ideas in the health tech industry, and what standards do you evaluate the pitches or the decks when they approach you? I believe the health tech has its own uniqueness. How do you approach that?
So on health tech, broadly speaking, there are two ways to go about it, or two types of companies we see. One are in the space where they use technology to help automate existing flows, right? It could be around patient-centric or insurance-centric or provider-focused. And they naturally are not heavily regulated. So that's one. The other tends to be a lot more heavily regulated, and penetrating a provider on a diabetes solution may not really work for you if you don't have the right clinical studies to back you up, right? And clinical studies take time and effort, and which may not really be the thing for you, right? So the few companies we've seen in health tech which find interesting are on the first part, not really on the second part, right? Hardware is not really a thing in this part of the world where medical hardware or is sort of executed on, but tech stack and tooling for existing healthcare providers, which you can get by without being in the purview of regulation, is an interesting business model for us to look into and build a perspective on. Again, if I were to sort of simplify it, which I will be doing not an injustice to it, but simplification, like commercialization is an important, again, consideration. How many POCs do you have running? How many of them are paid? What are those clients or partners of yours are sort of reacting and saying on those particular POCs? So those are a bit more data points that we look into to form a perspective.
In fact, you were very much emphasizing on, on the ability of accessing the right capital. My question is, I want to understand, for example, UK experience, UK or Europe experience, because you highlighted, in fact, how government can support entrepreneurs in selecting the right capital, depending on the type of the project and the stage of the project.
My simple answer, I suppose, is the UK is not a very good example to follow, actually. In fact, I would say, even as far as to say, it would be a terrible example to follow. The UK has been awful, has an awful track record in supporting science and technology. And filling that, it's called the valley of death, I think, in the industry. But essentially, in the UK, science and technology has not delivered for the economy in the way that it could have and should have done, and that's largely a product of government failure and finance industry failure. The market has not really stepped in and not worked to help technology businesses commercialize. So many of the best discoveries that came out of UK universities like Oxford and Cambridge and London, some of those best discoveries have many of them, most of them in fact, have been commercialized in the US or in Europe. They haven't been commercialized in the UK. Capital providers basically, for example, we were talking earlier on about sequencing. the first generation sequencing technology was developed in Cambridge by a company called Selexa. Okay, now that company really struggled to get funding in the UK to take the technology on from incubator level. It was post incubator, but it was sort of Series A, Series B type business, and they were really struggling to raise the capital to develop the technology, and as a result, Illumina, which was then a US company that nobody really heard of, came over to the UK, bought Selexa for $600 million, which seemed like a great exit at the time. It was, but within 10 or 15 years, that company had a $60 billion market capitalization because it dominated the sequencing technology using the Cambridge developed technology. Now, that was just one example of a missed opportunity. And the reason that company was taken over was because it couldn't access any development capital, growth capital in the UK. Nobody was prepared to back it. And as a result, it sold itself to a US company. So that, if my advice to any sort of economy would be, make sure that you have a capital pools dedicated to supporting homegrown technology, science and technology companies when they leave an incubator like this. Because that's when they confront the biggest single challenges. They need more capital, but there's less of it around in a place like the UK, and that's why we've failed. So I think there are some important lessons to be learned from what we got wrong in the UK.
Question for Omer. My name is Adit Rao. I'm building an asset-heavy, sustainable supply chain solution for the UAE market. Just need to understand, how do you guys look at it in terms of investments, and where is it that you prefer to enter? Because fortunately, just yesterday, my company was registered in Dubai, and the journey is about to start. So should I be approaching you now, or should I be approaching you when the asset gets to the ground?
Okay, thank you. On asset heavy, and we've seen a handful of companies. We actually have templates for them internally. Most asset heavy companies are not venture, so don't expect that your ownership or your dilution will be similar to a software company. And plus, most VCs will not look at asset heavy companies because, again, there's no problem with some business model being asset heavy. It just becomes a lot less scalable or requires a lot more capital for it to scale, and then you need the likes of banks and others to sort of fund that. That's one, and the other is feel free to reach out whenever. Like, we do pre-seed to Series A, like 1/3 of our investments were pre-product, pre-revenue, where we effectively underwrote founders on a business model or a market.
I have a lot of ideas, but one of the things I've been afraid of is the intellectual property. And you frequently talk about talking to investors and raising capital, but that means sharing your ideas. So what's your advice in terms of legalities? At what stage do you need to kind of protect your intellectual property? And how, do capital investors look at an idea or a pre-seed or an actual company that doesn't have the right legal structure in place?
You may not like my answer, but I do not believe IPs are defensible. That's me and perhaps most of Shorooq. Outside of certain sectors where we do look at IPs, like deep tech, we do look at IPs. The semiconductor company had a few IPs, and then IPs or patents across certain geographies as well, because they were operational in Asia, sort of North America, and even Southeast Asia as well. But the rule is that IP alone or by itself is not that important of a consideration for us to make investments. And I caveat that by saying that, again, we don't really or mostly invest in deep tech. Like, deep tech continues to be a very small percentage of our sort of exposure.
I just want to add to that. There's multiple programs in Abu Dhabi and the UAE that supports IP registration, right? So whether you're doing it through the DED or ADGM, there's the NDA. But at the end of the day, you need to speak to the investors. You need to really promote whatever you're trying to build out, right? And eventually this comes out. So as Omer mentions, it eventually doesn't matter, right, as you come in.
So I guess my question is kind of open-ended to both of you, but on the back of always having capital so that we can support founders in their growth journey. The VC ecosystem here, how do you see, I guess Omer specifically, but do you see VCs here, the trend here for, I guess, reserve planning be something that's commonly done so that you can always put aside money for the winners? Or is this just sort of ad hoc allocated? Or is that something that VCs model for when you're planning your fund?
I think I can speak for most of the VCs in my peer group. I think we do model it. There's a very clear follow-on strategy. There's a very clear allocation for it as well. Some may be 60-40, some may be other way around. But I've rarely seen companies or VCs in my peer group which only do first tickets and then sort of disappear.
Thank you. And what about the UK market? Would that be something? I mean, I would assume that would be a trend that's also sort of captured there.
I hope I understand your question properly, but again, this is a structural failing in the UK. What tends to happen is that funds that are designed to back early stage businesses, so businesses in incubators or that are spun out from the incubator, so early pre-seed, seed type investments before they get to sort of A and B rounds, those sorts of investors, that they tend to be funds that are largely driven actually by tax advantages in the UK. I won't try and explain the system, but there are pretty big tax incentives that drive those sorts of funds. The problem with them, of course, is that the companies that have grown to rely on those funds, the early stage businesses in incubators and who have just left an incubator and are relying on those sorts of funds, the problem that they confront is that their investment periods are limited, they're not evergreen. And as soon as a business reaches a certain scale, either number of employees or value or age, they have to disinvest. They can't, not only can they not support you on the next part of your journey, they actually have to sell. So not only as an entrepreneur founder do you have to find the capital to take you on your next stage, you also have to find capital to replace them. And this creates an even bigger problem for young early stage businesses. So again, this is a problem that I would recommend this geography not to repeat. Don't create a system that gives all these additional headwinds. It's hard enough taking a technology from early stage to unicorn status. If your financing structures are inappropriately structured, that makes it even harder.
I kind of want to go back to the topic of health tech and biotech, just because I think it's a really interesting space. And generally, people tend to focus on human-based health tech and biotech, but we see that animal care is growing extensively globally, especially in this region where companion care is also booming, especially after COVID. There's a lot of things happening. What's your kind of future view of animal biotech and animal healthcare? And I think from both of you, I'd like to hear your perspective.
Interestingly, somebody I know from Oxford actually has been pestering me recently about an animal biotech company. I don't have a lot of experience of businesses in that area, and what you find actually is that lots of companion animal care and indeed ag care, ag tech, biotech is an extension of human biotech. So there's sort of tech transfer, if you like. If it works in a human, then surely it's going to work in something that has similar character, a mammalian-based animal production system, for example, or whatever. Crop tech is different, but we're talking about animals here. As I say, I don't have a lot of experience, but I think given how highly rated some stock market companies are in the UK and across Europe that are developed effectively pharma companies focused on animal health, they trade on massive ratings and it's quite a consolidated market. I would imagine there's a lot of potential here. It's not as crowded a space as human biotech is, that's for sure.
Thank you. Maybe your perspective as well from a more regional perspective?
Like one of my favorite companies I looked at and we eventually didn't invest in was in the pet care. I do really like the pet industry segment overall. It's quite neglected. But one of my learnings through that entire experience was that this region is not a huge or a sizable market despite all of us running into pets almost on a daily basis. Just to give you a comparison, I'm just trying to remind from memory, but the amount of pets in the city of Miami is 12x that of this region. So that company eventually then rehoused themselves in North America. Because again, like even if you were to build here, you will be able to create a business, but not a venture outcome. Perhaps that helps. But on like health tech specifically, we've not seen any, at least coming out of this region.
Okay, that's time for us. I'm getting looks from the team in the back. Thank you, Neil and Omer, for all the insights you shared today. Again, great to see Shorooq's success. Thank you for making some time to join us at Hub 71, and thank you all for joining us today.